So, Josh Brown, I want to start with Apple. Why? Because the stock's down about 7% intraday from Monday's high. Right? It was 164. It's at 152. How concerning is that sign in and of itself to where the market may be going from here?
Well, look, mathematically, it's an important weight in the market. And just because the stock is not acting well doesn't mean the rest of the market can't advance. But given Apple's size and given its importance to so many different strategies, styles, indices, ETFs, obviously it's something that everyone has on their screen. It's the most widely held, probably most important stock on the planet Earth. But I think the bigger issue here is the rallies that we've seen, including the historic rally off the lows that ended in the middle of August, really remain counter-trend. And, you know, I think a lot of times we make this harder than we have to. The NASDAQ 100, the triple Qs, have been in a bear market all year. The NASDAQ 100 has been below its 200-day moving average for 113 days in a row. It's had 4 episodes where it's broken above that 200-day moving average and failed all 4 times. So that's obviously trading information, right? Being below a 40-week moving average for 36 weeks, okay, maybe more interesting to traders and investors. But the takeaway for investors should be that there's no rush to be buying into NASDAQ stocks. There's no reason to expect any more than a bounce when they're rallying, so long as we're below this long-term moving average. It just doesn't seem that complex to me, and yet people keep getting surprised by it.
You know, Shan, I'll talk about a surprising stat. According to S3 Partners, Apple's the new #1 short in tables, in the short interest league tables. Tesla was the #1 for 864 days since April of 2020. Apple recently recapturing that crown. I'm wondering I mean, that's clearly a statement of some sorts on where overall sentiment is in the market. But again, people betting against what has been the most loved stock in the market for quite some time.
Well, not only is it only one of the most loved stocks, right? We're thinking about it in terms of something that Josh just brought up. It is continued pressure on technology stocks. It is continued pressure on the perception, not the reality, but potentially the perception that large cap tech stocks are going to continue to suffer as expectations for an asymmetric increase in rates happens in the first quarter of next year. I would argue, too, that the intersection of concerns about the U.S. consumer and perhaps even more importantly, the Chinese consumer, as we're waiting to exhale on when Chinese consumption is coming back, is where Apple sits in that intersection, at that nexus of all of these concerns and considerations. The other challenge here is that you could just be seeing people take exposure off the table. If I'm looking at my standard, to Josh's point, very widely held stock, looking to take exposure off the table in U.S. large caps in general, you've got a couple of choices, right? You've got Apple, got Microsoft, Google. You potentially have Tesla. You know, it's nice to see that people are taking that short off. Maybe it's because Musk isn't buying monitors for his employees to come back and use. Not sure. But I think this is where we're seeing the intersection of multiple trends. I don't necessarily think this will end. I think there will continue to be some pressure on tech stocks. And to Josh's point, haven't said that there's a big rush if we're looking at coming into the middle of October.